Okay, we're going to look at the net export effect. When the government finds that we're in a recession and that we need to increase aggregate demand, they oftentimes borrow money. And the point of borrowing money is to increase spending on consumption items, also to increase investment. So what we're doing is we're getting basically a boost from the government. So I'm going to put a plus here. The government is going to boost aggregate demand a little bit. But when they borrow money, there are some negative consequences, or some unintended consequences of that borrowing. And that unintended consequence lies in the loanable funds market. So this is the market where people borrow money from. When the government borrows money, they increase the demand for loanable funds. So here our demand consists of consumers and investors. But when the government borrows a large sum of money, such as $1 trillion, what happens is the demand for loanable funds goes up altogether, and as a result, that leads to a higher interest rate in the economy. And of course, more money borrowed. The problem with this is that investors are dependent on that interest rate. So when the interest rate goes up, which is a boost, or when the government borrows money, it has the impact of decreasing investment a little bit, or at least it can if we have that crowding out effect. We also can have what we call the net export effect, which is the point of what we're discussing here. The net export effect is also saying that when the government borrows money, it has an impact based on, or has an impact on exports based on what happens in the outside economy. So imagine several different countries, each with the same interest rate, and then suddenly one of these countries finds that their interest rate is much higher due to this crowding out effect. So now one country's interest rate is, say, 4% instead of 2%. Everybody wants to invest in this country. In order to invest there, they have to get that country's dollars. When the demand for that country's dollar goes up, the price of that dollar, in other words, how much of their own currency they have to give up, will also increase. So, when the interest rate goes up, when the rate is up, then I'm going to put the demand for dollars increases, which means, we'll also say then, the price of the dollar goes up. When the price of the dollar goes up, then net exports goes down, because people from other countries cannot afford as many American dollars, and therefore they cannot afford American goods. The key thing to remember is for both an investor and a consumer from another country, in order to deal with our country, in order to buy our stuff or invest in our country, they have to first get our dollars. As the price of as the demand for our dollars goes up, the price of our dollars goes up, which means people can buy less of those dollars, which means that they can't buy as many of our products. As a result, our exports go down. So coming back to our original graph, we had an increase in aggregate demand from the original government borrowing. Then the crowding out effect reduces investment and can also possibly reduce the net exports as well. Now, whether or not this is actually going to happen depends on a variety of factors. In recent times, we've seen very little crowding out because we've seen very little interest rate effect based on government borrowing. But if the government spending does, or government borrowing does cause the interest rate to increase, then it will have a negative impact on business and on investment and on exports. How big an impact depends on those different scenarios. It might cancel out the increase in aggregate demand altogether. It might have only a minor effect. It is even theoretically possible that an increase in government spending could actually decrease aggregate demand, although I don't think that's ever really been seen in theory or in reality. So to summarize the net export effect, when the interest rate goes up due to borrowing, the demand for the dollar goes up, the price of the dollar goes up, which means American goods are more expensive, which means we export less. So a decision made to boost aggregate demand has the possibility to also negatively impact it.